Okay, so this is the last module in our session. It's going to be a little different from the others in a couple of ways. Um, One is, this is of course a session on big data. And this isn't necessarily a project or a framework that I'm going to talk about that has a lot of micro data. It's certainly going to be the other end of internet scraping and all that. But I'm going to talk about a framework that uses data on sectoral prices and output and linkages across many, many countries, many, many sectors, and potentially many years or quarters or even higher frequency in some regards. Which relative to where multi-country macro models were not that long ago is a bit of big data. So just sort of shifting your mindset toward macro big data, but it is an empirically heavy area. Second of all is it's going to be a little different in style how I give this paper compared to the other three modules or discuss this area of work. It's very math heavy. It's a model that I'm not going to have any chance to get through and sort of teach you how to grasp the full intuition behind the model in such a short period of time. Instead, what I want to do is give you a basic idea of the approach, introduce some of the modeling elements, but then of course, if you needed to double click, you could look at the paper itself. Instead, I'm going to try to get to show you and showcase, what these kinds of frameworks can be used for. What am I referring to? I'm referring to dynamic multi-country trade models. And you might say, well, why do we need a dynamic trade model? Don't we have, for a long time now, dynamic open economy macro models that do the trick? And for a lot of purposes, the answer would be absolutely. But our typical open economy macro models that incorporate expectations and dynamic behavior and all that, they typically have two countries, maybe three. One country might be called home. Another might be called foreign. And there'd be no notion of a country like Mexico, let's say, which would be Mexico in the sense of very close to and influenced by the United States and a particularly large producer of a particular sector, let's say, kind of manufacturers. And you might want to be able to represent that with some realism in an academic model. You might want to try to answer with some quantitative seriousness, what if there's a tariff placed between US and China? What is the implications for various sectors in Mexico? And that kind of question requires, sort of a model with serious geography and input-output linkages. On the other hand, you might say, well, look, trade's been able to do this for a while. We've had rich quantitative trade models since, Eaton and Cordum and Melitz innovated the field in the early 2000s. Why do we need this to be dynamic or have any of the macroeconomic elements? This is probably a crowd that wouldn't ask that question, although others do. But in our standard quantitative multi-country trade models, there's nothing like endogenous deficits, let's say, just to pick one example. Or you can't really analyze changes in expectations about the future, persistence of shocks, or things that obviously are also of import. So the idea is to try to talk to you guys about some recent efforts that have been made to incorporate all these elements into one framework. And the basis of this talk I'm going to give now is just sort of my work in the area together with Eaton and Cordum and John Romalis. But this is now already 4 or 5-year-old work. Toward the end, what I'll do is I'll make a point of highlighting some of the shortcomings of our framework and some of the areas in which people have more recently improved on it and extended it and done their own thing that's related but better in certain ways. And I'll also highlight elements that I think clearly need to be improved that no one's made progress on. Again, with an eye toward, planting ideas if any of you are predisposed to consider work in this area, okay? So the way I'm gonna proceed, the actual model itself, as articulated in the full paper, is quite rich. And it obviously has to be in the sense that I had just pitched this as a way to incorporate very serious and quantitatively realistic input-output structures and the ways in which different economies are different. So there's many, many, many parameters. None of that is important at a theoretical level to understand what we do, though. So what I'm going to do here is present a simplified model. Simplified in the sense that there's just going to be 2 sectors, consumption and investment instead of many, up to 40 sectors. There's going to be no intermediate input linkages, even though intermediate input linkages is going to be critical in the full-blown model. There's going to be no heterogeneity. So, the US auto sector in this simple example I'm going to give you will produce with the same labor share as the Mexican auto sector. But in the actual full-blown, framework, we can actually handle and accommodate that those differences in a realistic way, which is part of the point. And again, because I'm going to be going through everything quite quickly, I just want to note that there are these embedded hyperlinks in the note or in the slides that are going to be posted on the Stanford website that will take you to a full note and code that implement even this simplified case as opposed to the full-blown case from the paper. Okay, so that's what we're going to do. Here again, up to the standard that I just want you to get a basic idea on how this all works as opposed to a deep understanding of the equations. Let me take you through the model. We have a model with potentially many countries and two sectors, a services sector here and a goods sector denoted by D there. The services sector I'm going to assume is non-traded, leads to consumption. The durable is traded and is an investment good, okay? And each of these goods, the consumption good and the investment good, or the services and durable good, are themselves aggregations of a continuum of underlying varieties Z. Okay, so these are sort of bundles of varieties. In the services case, I'm going to assume that the bundle is sourced domestically because it's not traded. But the way that countries are going to interlink around the world is going to be the fact that this bundle of varieties that causes the durable investment good, or that creates it, are going to be sourced from all over the world. And the reason that this this module fits into this broader session I've had with Alberto is that the way in which countries source products is going to differ based on geography. So for example, the United States will source a part from Mexico at one price, whereas Australia might source the exact same part from Japan at a different price. And the reasoning for the different sourcing structures is geography, the fact that trade frictions are going to differ across those two bilaterals. And so this will generate PPP differences, and that's the sense in which this is also related to the work that Alberto and I have been presenting so far in the earlier modules of this session. What mathematically is the input that generates this notion of geography in the model? Well, I'm going to assume an iceberg trade friction, and actually here, I shouldn't be circling so much. Let me put a square around that particularly special term. The DNIT is an iceberg trade cost applying for goods purchased by N from I at time T. What that means is if that value was 1.1, let's say, it means that country I would have to ship 1.1 units of the good to country N in order for country N to consume one of the units. Like 10% of that good disappears as it's floating from I to N. That's the sense of the iceberg trade costs, okay? And notice that I've got it here in blue. Blue means it's going to be one of the shocks or structural parameters or disturbances that I'm going to allow to change to a great degree across space and time. So already you can tell if there's, 20 countries, there's going to be a little less because of the diagonal, but it's going to be 20 times 19 different DNI values at any given time T. And this is only one shock that enters the model, or one structural disturbance that enters the model. The approach here is going to be like business cycle accounting, for those that know Chari Kehoe and McGrattan's work, where we're going to essentially saturate the model with a lot of these structural disturbances or shocks, so many so that we can fully fit, the model can fully explain without any residuals or error terms, all possible elements of the data. So there will be thousands of these structural shocks. And the name of the game will be to build up a model such that you could then take it to fit the data perfectly and then extract what these blue structural disturbances are to try to see what they look like and compare them across countries. They can be interesting in explaining a given trajectory of the global economy. With that in hand, you can also do alternative exercises like consider counterfactual scenarios. You can say, well, let me change all these DNIs to replicate or simulate a trade war and see what happens. That's the nature or the flavor of what we're doing, okay? Now, there's going to be 5 such blue structural shocks, and so I'm going to kind of show you each of those sets as we go. Production is going to be Cobb-Douglas. So countries produce a variety Z in country N at time T using a Cobb-Douglas aggregation of labor and capital. Again, you can tell in this simplified example, you know, the coefficients on labor and capital are homogenized just to make it sort of simple to present. But in the full-blown, you know, approach in the paper, you know, each sector and country would have its own specific capital share and labor share. And in fact, here you see there's no materials, but in the full-blown paper, there would also be some intermediate input share, which itself would have a sector and country specific output elasticity, specific share. Now, the productivity term, this is just a Hicks neutral productivity term here, A is going to be drawn from a Frechet distribution. That's what's shown here. So for those of you that know the Eaton-Korda model, that have studied trade, you know, this is sort of the magic, or part of the magic, is posing the productivity distribution in this particular way. And this gives us the second structural disturbance, which is this capital A term. What that is a shifter of the distribution. You can think of it like the country's productivity, N's productivity level in sector J. But formally, structurally, it will enter the micro foundation of the macro equilibrium in this way as a parameter of that country's distribution from which it draws its productivity. Okay. There's some adding up constraints in the model. So here we just see that each country's capital, so this is country N's capital K at time T, is just equal to the sum of that used to produce the investment good and that used to produce the consumer good. Same is true for labor, although note that labor is now in blue. It's the third structural disturbance or shock that in our framework, you know, we'll simply input. This is, of course, a limitation. It's not a great feature that what we have to do is just read off of the data how many workers in each country are showing up in each you know, period of time. It would be better if that was an outcome of the model. And when I get to the sort of future work and suggestions at the end of this talk, that's one area where people have made improvements. Capital will accumulate in this model. So just to make things simple, imagine setting alpha equal to 1. That would be the case of no adjustment costs. And then it would be simple to see that capital is just equal to chi times I. That's chi times this period's investment plus the undepreciated capital stock from the previous period. But this chi, of course, is our fourth structural disturbance. Again, that's a shock that we're going to allow to vary freely over time and across countries. We'll allow it to move and be whatever it has to be to explain the investment behavior in that country at that time period. Again, the idea is this is like an investment efficiency shock. That's the phrasing I think introduced or at least used by, you know, Primacheri and co-authors. But you can also think of it as essentially a shifter in demand for investment, okay? Finally, the fifth structural and last parameter that will sort of allow to vary a lot across time and space to explain the behavior of the data is that we'll specify that preferences are additive across time in log consumption with shifters, in particular these phi n shifters of marginal utility at any given point in time. And there will be a normalization on the fees such that that really captures your relative preference or your relative marginal utility shift compared to the rest of the world in that period. Okay. Given time and given, you know, there was never going to be a great way to develop a deep intuition for everything that I'm trying to present quickly enough here. I'm going to have to let you look at the exercises and notes and paper to do that. Let me instead just focus on one particular first order condition that I hope gives you an idea on how the guts of the model works, sort of what the intuition is, because I've basically already presented the model. Those are basically the key equations in the model. That's kind of it. Here, though, is an example where in the model, the price of the investment good in country N, D for durable in country N, you can see is equal to this analytical expression that relates to objects in the whole rest of the world. Every other country I has wages, W, has a user cost or rental rate, R, has a productivity, AD. You can see these things all here that are all going to matter for what happens to the price of the investment good in country N. In other words, if country N is the US's decision to invest or consume, and again, it could be to invest or consume in a particular sector in the richer version, is going to be a function of what's going on everywhere else in the world in this particular way. And the way in which geography is embedded is, note that there's this, again, DNI term there. Let's say country I, it's an infinite trade barrier to ship anything from country I to country N. Let's say hypothetically you simply cannot ship goods from I to N. In that case, DNI would be infinite. And you can see, given that this exponent here is negative, that means that you would fully discount the wage, rental rate, and productivity of country I. They simply would no longer matter for anything for country N, at least for country N's investment. And so it's in this sense that the whole rest of the world will matter for country N's behavior and macroeconomic state. And the rest of the world will be weighted based on how close they are, in the sense of how easily it is for them to ship goods to the United States, to country N, which is going to be encapsulated again by this DNI term. Okay, so there's a lot of richness going on. Also, again, remember that this is the simplified model where there's no intermediate inputs, which is why all I care about in other countries here is, you know, their wage and their rental rate and their productivity. But in the richer model, where intermediate inputs are also used in production, well, then I also care about the price of all of those intermediates, again, all around the world. And again, weighted by this DNI term. In other words, if I'm an auto consumer in the United States, I care much more about the price of steel in Mexico, which presumably is where a lot of my final auto expenditure is assembled, than the price of that same good steel in, you know, New Zealand, where presumably it's less important. Okay, so this is how this all works. Okay. Okay, so I mentioned that in the proper model and in the proper, you know, paper and approach, things are qualitatively, theoretically, exactly as I just described, which again, I know you'll have to dig in more slowly to totally follow, but richer in terms of the ability to characterize differences across countries. So here you can see that instead of just having some particular capital share that applies everywhere and always, in the actual paper, there will be a capital share that's specific to country I and specific to sector J and specific to the type of capital K. In other words, we'll be able to take into account that there might be a different capital or labor or intermediate input share in the production of structures, which is one particular type of capital, you know, in Mexico, compared to equipment, which is a different type of capital, you know, in the production of a different sector in Japan. Okay, so that's the idea on the richness. And the rest of the data requirements, they might be or feel or seem quite daunting, but it's not so tough. You really need sectoral production, which you can usually get from many, many countries from sources like the OECD or the World Input-Output Table or the Trade and Value Added database. You need bilateral trade shares in each sector. You can get that from lots of different sources, including ComTrade. There's information you'll need on sectoral prices. that you can get from, PPI indices, for example. And then you'll need growth in labor supply, which you can typically get from sources on employment across countries. If you have all this, you put everything together, you solve the model, you still have a little bit of work left to do on the computational side. And here's the reason. Your standard macro model that you might have in mind starts from a steady state, or presumes, deviations around a steady state or some such thing. But that's not such a helpful assumption to make when you're trying to calibrate to the actual current state of the world. You want to make the world in our model look realistically like the world out there in 2018, let's say. So what we do is we show an algorithm how you can solve for the key state variable in the system, which is going to be the capital stocks in each country and sector. You treat it like a latent variable, and you find what value of capital, together with the systems of equations and together with assumptions about the future. You have to input some assumed path on those structural disturbances. So you say, what if, trade frictions don't change going forward, there's no trade wars, etc. And you say, what would they have to be to carry the system to a future steady state? Let's say you hypothesize that China has, no capital and the US has a huge amount of capital today. Well, then the system, when iterated forward, might, crash down below or skew off toward infinity. It's very much like the standard neoclassical growth model, where, if you're given a path of productivity and you're given an initial capital stock, that capital stock has to grow along there's just one specific path that it has to follow. And any deviation will not lead toward a future steady state. Same is true here. Once you obtain that sort of characterization of where things are at the end of the data that you've got, let's say in 2018, well, then you can use the equations in the model to go back in time and ask what must have been the behavior of those shocks to reconcile the data. In other words, what must have been the investment demand shock in China to reconcile through the lens of the model the behavior of investment spending in 2013? Or what must have been the trade friction between the US and Canada in 1998 to reconcile the change in trade flows between the US and Canada in 1998? Okay, that's the idea. Once you've got all this stuff, well, then you can do some pretty neat things. And here's where, I kind of wanted to make sure to get here. I know I'm eating a little bit into everyone's lunch, but this is to showcase sort of what all this work would deliver. So you can do things like ask, how did these shocks look like over time? Which itself is pretty interesting, especially when you compare across sectors, across countries. You can run counterfactuals from the past. You can make guesses about the future. These are the sorts of things you can do. And let me give you an example. So first, I should just sort of show you visually what that algorithm looks like when we actually apply it to real data. I showed you that schematic on how the capital stock, you sort of have to figure out at a given point in time, given some future assumed path of the shocks, what it is, and then you can back out what was happening during the life of the data. Here's an example. For durables, right there, that's a value of 1.1. Our exercise said China's durable capital stock must have been growing at about 1.1 or about 10% in 2015. The point at which we assumed afterwards shocks didn't change. And then it allows you to see sort of, well, where did that, what does that mean the growth rate of China's equipment capital stock must have been in 2010, and you can go back in time from there. And you can see, the exercise looks different for structures versus durables, because structures has a low depreciation rate, and durables, of course, has a high one. You can then extract shocks also in sample. So the purpose of this paper, the motivation ex ante at least, was to try to verify the claims made by some at the time that increases in trade frictions, things like protectionism, were at fault for the collapse in trade that we saw in 2008. So one way that we look at that is we say, well, look, the model says that to fit the experience from, I think we had something like 2000 to 2007 or so, you needed global trade frictions, these DNIs, or D hats here because it's in change form, to be typically declining by 1% a year. That's what's meant by 0.99, a decrease of 1% per year, which makes sense. It's a little bit of globalization steadily over time. And we actually found that during the recession itself, on average, there was no difference. That's an example of the kind of thing that we use this framework for. By contrast, one thing that we noted was, if you looked at productivity in the construction sector, C, that's one area where you saw a really big drop. The model says that during the recession, something really special happened to the construction sector. It lets you look at investment spending and notice that, for example, in China, it's one of the few countries that, during the actual recession itself, things moved apace. In fact, a better way to show that would be to show these extracted chi shocks. Because worldwide, to explain the recession according to the model, there had to be this collapse in durable investment demand. But to explain the heterogeneity in the recessionary experience across countries, you needed to note that actually that drop in durable investment demand does not characterize the experience in China. This kind of heterogeneity, if you want to capture it, these are the sorts of models that let you do this. I'll wrap up by just showing a few counterfactuals where what we do is we run the model only inputting a certain subset of shocks. So, and actually, let me skip this and jump to this one. Well, sorry, let me go back. This plot is meant to show what if we only input into the model certain sets of shocks one by one. For instance, the green line here says, what if we input into the model all the estimated trade friction changes that we extracted? The ones that I just showed you a little bit, for instance. Well, the green line shows that the path of trade basically would have continued largely unabated. That's a visualization of the same conclusion I said a couple slides ago, that our paper concludes that trade frictions were not, the main thing driving the decline in trade relative to GDP. By contrast, if you just input the investment efficiency shocks in the durable sector, that generates this downward red line, which you can see is sort of the only one of the shocks that on its own does a somewhat decent job of capturing the dynamics of trade to GDP. You can ask instead, what if I don't care so much about trade, I just care about relative GDPs of countries? And I should be clear, this is about their relative shares of world nominal GDP. But you can create plots like this where you say, what if I put in demand shocks and ask, what does that produce for GDP in terms of the counterfactual compared to the actual data? And what you'd find is for some countries like Great Britain, it kind of does the trick. It explains things. Or Canada, Canada, even the United States to some extent, just the demand shocks around the world to a large extent explained in this sense how their GDPs fared. On the other hand, if you look at Poland, or China, which are way off the y equals x line, this model suggests that those are countries where you need something other than demand to explain what happened. Another useful way to think about what you could do with this framework is to ask, how do foreign shocks influence behavior in the home country and vice versa? And so one way to see that was to look at, we ran a counterfactual where we included all shocks that applied to all countries, but none of them that applied to Germany. So we turned off the negative demand shock in Germany. We turned off productivity shocks in Germany. We turned off trade friction shocks that influence Germany, but kept everything else on. And you can see, for example, that Germany's export experience still lies somewhere along the 45-degree line. Germany's production experience lies very close to the 45-degree line. This is a visualization of our conclusion that shocks not in Germany were largely the cause of the equilibrium behavior in German exports and production, for example. but not, of course, German imports. In such a world, Germany would not have had an import collapse that looked at all like the one that, in fact, it saw in the data. Let me finish up, this is the last slide, but I think an important one, by noting some important shortcomings, as well as what some other papers in recent literature has done to try to plug those gaps, and also some opportunities if any of you wanted to try to build on this. The first actually has to do with one of the modules I presented yesterday on the net foreign asset position. In my paper, we actually solve a planner's problem, which means that when shocks occur, the present value of future trade balances for any given country can change, and actually can change in largely unrealistic ways, okay? And I say that this relates to the net foreign asset position because absent valuation changes, remember that the net foreign asset position should tell you something about the present value of all future trade deficits, okay? This insight actually was built into our framework by Ricardo Reyes Heroles in a paper in 2016, where nicely a country's net foreign asset position is the key state variable. And so when shocks occur, it changes the path, the trajectory of future trade deficits, but not their present value, which is an improvement, I think, over what we do. On the other hand, things could and should get even better, because when there are big shocks, like there was in 2008, net foreign asset positions, as I showed you yesterday, are not stationary, or are not stable. They do move, and they move in ways that, as I talked about yesterday, data on net foreign asset positions should be informative about. For instance, if you know a country holds a lot of foreign yen-denominated bonds, then shocks to Japan should move the NFA in a somewhat predictable way. I think that's one area where these models could be expanded and improved. To go quickly through a few others, our model relies on Ces substitution patterns. A lot of very nice work done by David Bakke and Emmanuel Fari, who we've all talked about a lot this week. Shows that that assumption may be too strong and restrictive, and that more flexible substitution patterns can change the quantitative response of the system. Our paper requires a lot of computational work, and that's been improved and simplified in a similar framework by Ravi Kumar and co-authors. As I mentioned, we have a very boring, unsatisfying labor market in our paper. There's work by Caliendo, Dvorkin, and Paro that, for instance, incorporates nice labor market dynamics into these sorts of models. Finally, one element of these models that no one's introduced yet, not because it's very hard to, but which is sort of a glaring omission, is that there's no notion of currency. There's no nominal rigidities in any of these models that I'm aware of. So you can't do things like have an asymmetric response in the United States, where we know, there's largely dollar stickiness both on imports and exports. So that could be an opportunity. Finally, I do want to note that even outside of this sort of mold of quantitative dynamic, sort of trade macro models, there's a lot of great related work. So if interested in this area, I would recommend, reading the work by Alessandria and Rule, Rossi Hansberg, Waugh, and their co-authors. I do think that this is an area in between fields where the possibilities of real improvement and gains in the next 5 years is quite high. So with that, I'll stop and we can stop the recording.